Hello and good afternoon, and welcome to another episode of Lunch with Lucern. My name is David Hansel. I am one of the founding partners and managing members of Lucern Capital. We are a real estate private equity firm based out of Red Bank, New Jersey. We primarily invest in multifamily and industrial assets. We are focused in the Sun Belt with a heavy concentration in North Carolina. A lot of the investments we've made over the last 6 to 7 years have been in the Charlotte market specifically. This Lunch with Lucern series is really just a way for us to share insight and thought leadership on some of the topics that are pressing operators and investors throughout the industry. And as I mentioned, no better time to talk about financing than today. For those that are not aware, it's been a big challenge that kind of started at the end of last summer when the Fed began raising interest rates at a very fast clip. This is creating definitely some real challenges for the banks, for operators, investors alike. So let's get started here. So with anything, when making an investment, it's important to be diligent, and financing plays a very critical role in a deal. You could have a great project with terrible financing that will just not turn out great, or you could have a mediocre deal with really attractive financing that can make that investment much more palatable. So when you're looking at financing, you need to start early, and we at Lucern have primarily worked with a couple very well-vetted financial brokers or mortgage brokers that will go out to the market, understand what we are looking to achieve, and match us up with the best or most ideal capital for that specific project. So you always want to start with the end in mind. You need to understand, what are you looking to achieve in a project? How long do you intend to own it? Are you going to need a lot of capital improvement dollars? If you do, that may mean you're looking for more of a bridge or a construction type lender versus a stabilized asset where you're going to get more of a traditional conventional loan or insurance capital. So it's very important to understand what the plan is. As we look at a deal, we're not only looking at the rental comps, we're not looking just at the general market and the condition of the property, but we're looking at what kind of financing is available. If there was no financing available at all for a particular asset class, we would likely not be investing in that asset class, no matter how attractive the basis is, because you want to have some portion of leverage, and you need to understand what that means to you and how it's going to affect you. So develop the business plan, get on the phone with your commercial broker, or if you have direct contacts to lenders, you should start right away, because when you go to make your offer, you want to understand what the cost of the capital will look like and how long will the capital be in place. Do you have to look at another refi scenario during the life of the project? And you have to weigh out what risks come with that. In an uncertain market, you don't want to be exposed to having to go out to market again and get new financing. So say, don't be quick to take the first option. A good mortgage broker will come with multiple options. You can evaluate the different lenders, what they're offering, and then go back and try to fine tune and select the right operator for you, or the most ideal lender. So how different types of loans can affect your investments, right? So if you have a heavy construction project, or you're going to take a complex and renovate units and put a substantial amount of dollars in, you're going to need some kind of construction or bridge type loan, right? Because if you go conventional, they're going to offer you a percentage of the purchase. Maybe it's 70, maybe it's 60%. Any other capital that's needed to improve the asset or do renovations are going to come from your own pocket or capital you've raised for CapEx. So if you're doing smaller improvements, you can go for conventional, or maybe the cash flow of the project will support the reinvestment of the projects that you're going to need to execute on for your business plan. However, if it's a significant amount of dollars in each project that will be determined by the project itself, that if it's a significant amount, you're going to want to have that built into the loan. So if you're going to go in and renovate 200 units and you're looking at $2,500 per renovation, that's a big nut, so to speak, and you'll want to build that into your financing. That financing is likely going to bridge you to a certain point in time where you effectuate the business plan and get that work done. And then you're going to have to go back to the market and look for new financing. Well, in this environment, if you're going to have to go back to the market in 2 years with a lot of uncertainty in what's been going on, you may want to think twice. You may not want to be exposed to that risk. Or if you feel comfortable that rates are going to settle and leverage is going to come back from the banks, then maybe you do want to take that risk. But those are business risks that you as an operator would have to make. We've been conservative ourselves, and especially with everything that's been going on, that we will sometimes pay up for longer duration paper to avoid those potential pitfalls. But your mortgage broker will walk you through those options, and a good mortgage broker will give you the pros and cons to each of those pieces, so to speak. So with anything, doing research is critical, and we have analysts at our firm that go through and pull together all the underwriting and the comps at our direction. And that's used in combination with the information we get from our mortgage brokers. But you want to look at, when you get these term sheets and offers to finance your project, it's really important to read everything in detail, because the devil is in the details. And there could be everything from prepayment penalties that may cost you a lot of money if you have to exit the asset in year 1 or 2 or 3. There may be an interest-only option where you're not paying any principal down, which keeps more cash in your pocket in the earlier years of the investment, and then it converts to a stabilized and amortizing loan. Those can be attractive for assets where you can quickly come in and turn things around and increase the bottom line revenue, so that when you do stabilize out, that you'll be able to hold, that the cash flow and debt service coverage ratio will be attractive. So these are all different types of things that you want to be making sure you're diligent on and talking with your broker. And having a broker that you can trust and that has been, in the business and has worked with other groups like yourself is important. And you need to, this probably goes without saying, but you need to understand the market that you're in and the current conditions. Sometimes local lenders will be a good option for an asset, and they'll kind of, each market, that these banks and lenders will dictate terms that they're interested in and that fit within that market. But you got to be careful about all the fees, or maybe they want to have appraisals done throughout the life of the investment, or updated financials and things of that nature. So you need to be prepared and make sure that you understand all those pieces, and your team is capable of delivering that. So I've talked a bit about the brokers, and I can't stress enough how important this relationship is. Obviously, you can go out and do this yourself, but there's hundreds, if not thousands, of lenders, and especially in a tighter market, It's hard to identify all the best options. It's kind of like going fishing with a fishing line, and putting a few lines in the water or throwing a net out. That broker has a much wider net, so to speak, and has a lot of relationships with other lenders, and knows which lenders like and prefer certain types of assets, and certain types of risk levels. So you want to look to them for guidance. You want to find out what projects they've financed over the last year, what, if they have a specialty or lean more towards bridge, or do they do the whole capital stack? If you need equity, can they do that as well? And then as you build that rapport, they're going to be the best negotiators on your behalf. They're going to know what you're looking to do. They want loyalty, because they know if they do right by you, that you're going to keep coming back to them. So invest the time into them. Even when you're not in an acquisition mode or looking to refi, you should keep up and talk to them. Find out what's happening in the market. They're a great resource because they're tied to what all of these lenders and the banks are doing. So these are some of the things that you need to consider when identifying that broker. Obviously, we've touched on a bunch of these, but the research, do they have a good reputation? Can you get references? What experience do they have? How many years have they been doing it? What kind of debt have they placed? What's their ability to comprehend your financial models? Do they provide insight back based on what they're seeing in the market and give guidance on that? How is their fee structure set up? What are they paid as a percentage or basis points of whatever loan that's made? You want to get that addressed up front. What other services can they provide to you? And a lot of it's really just about the time and effort and putting their full mind and thought process on your project, and being responsive. Because when you are looking at making an offer, you need to really quickly get this information, and you need some real bids from the market. Will they be able to act quickly? And that's part of the service, because if they can't, and they're really good, but you don't, they're not there to deliver when you need real numbers to put in your model so you can put an appropriate offer together, then they may not be the right fit for you. And that ties in with communication, and making sure that they're getting back to you and communicating both the lender's needs and the broker's needs to get that stuff taken care of. And lastly, just obviously, which I touched on, experience, is getting references. It's important to make sure that you talk with other operators that have worked with them, and make sure that they're comfortable, and they shared a good experience as well. So just recap here real quick. You always want to start with the end in mind. You need to have your business plan, understanding how long you plan on holding an asset. What are some potential audibles that could be called? Like, could you be holding the asset longer or shorter? How does the financing play into that? You need to make sure that before you're making offers, you understand where the debt is going to come in at. I typically suggest to folks that take the most conservative approach, model out kind of on the high end of where you think numbers and fees can fall. Obviously, if it works at that, then it's going to work at lower levels. If you're in a competitive bid, you want to try to be tightening up a little bit on that, but just be cautious that you don't get over your skis. And lastly, making sure that you find a really good broker, someone that's been in the industry that you can get references to, that understands what you're doing and can place the debt for you. So I'm going to wrap up here. I want to thank you guys for joining. Again, financing is such an important part. And right now in the market, things have been challenging. Banks have pulled back, leverage has pulled back, which requires more equity. and more insight from every investor. We're hoping and thinking that some of that will ease up over the next couple quarters as rates eventually level out. But right now, it's very important to really know what your lenders are willing to do, and figuring that out early. So thank you again for joining us, and I appreciate your time.